Hey everyone, and welcome back to Money Journey. Today we are diving deep into a fascinating new stock that's caught my attention, and perhaps yours too. As a viewer recently asked for an analysis, we are talking about Chagee, trading under the ticker symbol CHA. This company just had its IPO about a month ago, making it a very recent addition to the public markets. Now, when a new business goes public, it often represents a unique opportunity for long term investors. The key, as always, is to dig into the fundamentals, understand the business model, and assess its true valuation to determine if it's genuinely an undervalued stock or if the hype is simply outpaced the reality. That's exactly what we'll do today. We'll break down Chagee's business, explore its competitive advantage, analyze its current stock situation, and then wrap it all up with a solid fundamental and valuation analysis to see if SHA is a good long-term investment. Let's get started. So, what exactly is Chagee? Chagee Holdings Limited is a leading premium tea drinks brand, primarily focused on freshly made tea beverage. Think of them as a modern Eastern counterpart to Starbucks, but for tea. They have built a vast and rapidly growing network of tea houses, mainly across China, but with a significant and expanding international presence, particularly in Southeast Asia. Their business model hinges on a blend of company-owned and franchise tea house, allowing for rapid expansion. But what truly sets them apart? What are their competitive advantages? Firstly, it's their brand identity and cultural fusion. Chagee intertwines traditional Chinese cultural elements into its brand, offering a unique and authentic cultural experience that resonates with a broad demographic. This is just about selling tea, it's about selling a cultural narrative. Secondly, they emphasize premium quality and authenticity. Unlike many mass market bubble tea brands, Chagee focus on freshly brewed tea leaves, often sourced from their own organic tea farms and uses real milk. This commitment to quality and transparency, including features like product ID cards and nutritional grading systems, appeals to health conscious consumers and builds trust. Thirdly, their operational efficiency and technological integration are notable. They leverage technology to semi-automate tea making process, ensuring consistent quality and faster service. Their mobile app enhances customer experience with features like order tracking and calorie counters. Finally, their strategic focus on Generation Z and digital marketing has been highly effective. They actively engage on social media, run interactive campaigns, and collaborate with influencers, fostering a strong and loyal customer base. This deep understanding of their target demographics allows them to stay ahead in a highly competitive market. Shaggy looks like a very interesting business, but what the fundamentals say? It's a $5 billion market cap, forward P of 10, revenue growth 480%. So don't look into it because it's a very recent company. In 2017, they only have one store and they have been growing really fast, so it's a high growth company. In terms of margins, 46% gross margin and net margin of 13.8%, which is very good for a restaurant tea beverage company. So in terms of balance sheet, very stable, really good. They have $0.7 billion in cash and short-term investment, and their long-term debt is just only $50 million. So, why they have so low debt? Because when you look into restaurants, brands, they usually have high debt, but this isn't the case because they have a franchise model where others can invest with their brand and they pay a fees, a percentage of their revenues, and that's what happened. They don't have basically any risk into their stores, and the risk is passed to other business owners.
and they only sell their brand, but they have pretty tight contracts where they control the brand, the employees, the minimum quality allowed, some things like that. You can compare that like a McDonald's franchise model, for example. In terms of returns of invested capital, last year it was 44%, but if you look into the last 3 years, the average is 200. So it's a company very young. We don't have a lot of data, but from the data we see, this looks like a pretty good fundamental combo. So let's look into our money journey checklist. They've been growing really fast. High gross margins and net margins. For example, if you look to the free cash flow margins, in the last 3 years, the average is 21% free cash flow margin. So if they can have 20% free cash flow margin, it's very good. High margin business. Bear in mind they are in the tea beverage business, was in the premium side, so their margins are really good. And as we have researched, they are very efficient on their business. They have a lot of automation. They say some of their beverage, they can prepare that in 8 seconds. And when they change employers, or when there is a new employer, they only need the receipt for the machine, so they can instantly start working and being productive in the same day. So that is very efficient scale. In terms of that, their balance sheet have more cash and short-term investment than they have debt, so that's very good. Returns on invested capital has been pretty good. They've been scaling up very efficiently, having high returns on the invested capital. So this is an example of a very premium brand that has been doing a very good job growing really fast. In terms of moat and competitive advantage, I would say they have some competitive advantage. Their brand, their story, they invest a lot in influencers, in content, so they can create their brand and scale it very efficiently. Then for me, the biggest moat they have is their efficient scale. Their franchise model is something I really like. So if I want to invest in a restaurant, for example, I prefer and I'm willing to pay higher premium for franchise models like McDonald's. And then they are like a Starbucks. They are creating their brand, their premium brand, where the consumer goes there because they like the product. They have the best quality over there. And the tea beverage is a market that is growing a lot in the past 5 years on China, and they are expecting to grow around 10 to 11% in the next few years. So that is very good growth, and Chagee will grow with that. And if they can gain market share doing high quality teas, tippuccinos, another different beverage, they can be one of the biggest beneficiaries. And the consumer on China is recovering. So Chinese people is getting confident. The real estate crisis is going to the past. So they will. The consumer is starting to grow again, and I expect Chinese people to start spending more and more in services, products, food, for example. And that's at least my thesis, that Chagee can be very good in the future. They have been free cash flow positive because they have no debt. They have a very good product, very efficient, so it's easily scalable. So that's their biggest competitive advantage, and the quality is the best. They are not returning a lot of capital. They are not diluting the shareholders, but with their cash on hand, I'm expecting them to returning capital in the next future, because they don't need a lot of capital to invest in new stores, because that's a franchise model. So this is very good. High score in our checklist. Not a lot of data. They have been growing exponentially, expecting to continue to grow. Gross margins growing as they scale the business. Return on invested capital going down, but they just started 2023 375% return on invested capital. It's not sustainable. Shares outstanding, they increased the share when they started the IPO. That goes down. I hope they will not dilute the shareholders, but it's too soon. This is a really young company. We don't know what will happen. In terms of free cash flow per share, they have been growing at the pace of 3,755%, so it's incredible. This is a major growth, and they are expected to continue to grow. Of course, they will be mature. The growth will stall. I'm expecting them to grow around 10-15% maybe in the other years, but for now they are growing really fast, opening new locations every day, so that's very good. But in terms of fundamentals, I think this is a very good and interesting company. Of course, it's a tea brand. They invent a lot: teas with coffee, teas with cappuccino mixtures. But the tea market is a very big market on China, even though we Westerns doesn't understand that a lot. But for the growth we have seen, for the expansion this brand is having, this is a very good market to be in. At least I'm getting interesting. But what is the valuation saying to us? It is a Chinese company, so a lot of risk in there. In terms of business, I would say it's a medium risk because their balance sheet is incredible. There are not plenty of risks. I would say the risk is they only sell some types of drinks. Most of the revenue come from three drinks or three beverages they have. So consumer can get bored, want to try new things, but that's where they have to perform. So there are some risks, but overall I think it's a low risk. So my discount rate for my base case has to be a minimum 13% for a company like this. So on my base case, I will assume they will grow around 30% this year, 16% in 2026, and for the next 10 years, around 10 to 8%. A PE of 20, they deserve a premium. They are a premium brand, good margins, a lot of competitive advantage. So I'm willing to do a PE of 20. In terms of free cash flow, since it's a franchise model, so higher margins, since they are a premium brand, I'm assuming 20% free cash flow margin. With a lot of competition, this could be lower, I would say that, but it can be higher as well. So for my base case, I'm assuming 20% free cash flow margins. So I've done a bull case and a bear case, and with these assumptions I came with an intrinsic value of $32.9 per share. Right now the stock ended Friday at $28 per share, so 15% margin of safety. It's not, in terms of valuation, it's close to their fair value, I would say. Of course, we are already taking into some margin of safety on our discount rate, and we are increasing our discount rate because it's a Chinese company and there are some risks in being on China. But with that already, we have some more margin of safety of 15%. So I would say it's undervalued, or slightly undervalued. For a Chinese company, I prefer to buy them with higher margin of safety. Right now, when you compare to other Chinese companies that we have been analyzing this channel, Chagee, it's probably one of the most one of the company that is closer to the fair value. The others are usually undervalued, except for Tencent that has a bigger premium. But overall, very interesting company, well run, a good story, probably a company with a really good future prospects. And in terms of fundamentals, nothing to say. But valuation, it's not as cheap as we are used to see on China, but maybe it's a really good starting position right now. So I'll be looking into Chagee in the future.
So after this deep dive into Chagee, CHA stock, what's the verdict? This is, without a doubt, a very interesting business. Chagee has a compelling story, a strong brand identity, and a clear focus on quality that differentiates it in the crowded beverage market. Their rapid expansions, particularly through a well-managed franchise model, suggest significant growth potential. Looking at the initial available fundamentals, we see a business with a strong revenue growth and healthy profitability. While it's a young public company, early indicators suggest very good fundamentals for a business in this stage of its growth cycle. And when we consider the valuation, especially given its recent IPO and the growth trajectory, Chagee appears to present a compelling opportunity. Of course, new IPOs always carry a degree of risk, and the tea beverage market is competitive. However, for long-term investors seeking exposure to a high-growth consumer brand with a unique cultural position, Chagee, in my opinion, looks like a potentially good investment. As always, do your own true research, but CHA stock certainly deserves a closer look into your portfolio. If you found this deep dive helpful and want to stay ahead with your investment analysis, make sure to hit that like button and subscribe to the channel. Thanks for watching, and I'll see you in the next one. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.